Hello, and thank you for joining us. I'm Lori Berman from the Small Business Association of Michigan. I'm Vice President of Membership and Development. Thank you for joining us today, and a special thanks to Raymond for putting this program together for you all today. This program is part of our regular webinar series for small businesses across the state. We do have one next Friday, and we'll talk about that a little bit later. So let's get going this morning. I wanted to give you information on the three speakers. Today with us, we have Eric Schumacher. He's a CPA and Principal, Advisory and Tax Services for Raymond in Grand Rapids. Eric strives to help his clients effectively manage their tax obligations, whether through effective annual tax planning or transactional assistance. His client-focused service approach centers on consistent communication, effectively managing deadlines, and providing proactive solutions. Also with us today is Anthony Licaboli Jr., who's also a CPA and Senior Manager of Raymond in the Troy office. Anthony supervises tax engagements for clients in a multitude of industries. He is a member of the firm's international and income tax accounting groups. Anthony also sits on the firm's tax reform subcommittee, helping to develop content and tools to assist advisors and educate clients on the technical aspects of new tax legislation. Welcome, Anthony. And then finally, but last but not least, we have Susan West, an SPHR, a SHRM SCSP, also a Principal, Human Resource Solutions at Raymond in Troy. Her service areas are human resource consulting and outsourcing, leadership coaching and training, and strategic planning, with a passion for uplifting human resource functions and leadership talent in small to mid-sized companies. Susan focuses on providing the expertise and guidance for addressing improving HR business performance for clients. So welcome to all of our guests. Thank you so much for our speakers, and a special thank you to Sam Breggy behind the scene, who is running our slides today. With that, I will give it over to Eric. We will be answering question and answers at the end of this webinar today. Put your question and answers in the Q&A feature. I ask that you focus your questions on today's content. If you have other questions unrelated to today's content, please send those to sbam@sbam.org. That's sbam@sbam.org. With that, I will turn it over to Eric. Thank you, Eric.
Thanks, Lori. Appreciate everybody taking some time out of their day to join us. Just a quick background with Raymond. I'm sure many on the phone are aware of who we are and what we do, but for those that aren't, just wanted to take a few seconds here to let you know. Raymond is a top 50 CPA and advisory firm here in the United States with offices here in Michigan, Ohio, and Florida. We are headquartered out of Troy, Michigan, but as we sit here today, we have over 900 virtual offices at everybody's home, as we're a 100% remote working workforce at the moment, as I'm sure many of you guys are as well who's joining us. So today we're going to spend just a little bit of time here at the beginning going over some updates to the payroll protection loan program, Main Street lending program, and then we will jump into some of the tax relief and implications of the current programs and some of the other legislative changes that have come through the CARES Act. And then we'll finish up today with Susan, and she's going to cover a few of the FAQs and issues that she's been dealing with a lot of our clients that have been shooting things in as regards to some of the current legislation that's come out. So most everybody, I'm sure, on the call today or on the Zoom meeting here has seen and knows a lot about most of the SBA programs that are available. Primarily, we've seen a lot of interest in the payroll protection program and the economic injury disaster loan program. So we're not going to spend a whole lot of time kind of going over the highlights there. I think most everybody here has probably seen that through a number of different facets. But just there are some updates that we wanted to share before we get into some of the other items. So the payroll protection program, I've already seen a number of questions coming in talking about everybody being aware that as of yesterday morning, the $349 billion that was originally allocated in the CARES Act has been spoken for. Yesterday, early morning, the SBA made an announcement that they are no longer accepting applications for either the Payroll Protection Program or the Economic Injury Disaster Loan Program. Both of the funds that have been allocated to those two programs have currently been spoken for. There is, however, some potential legislation that's being hashed out at Congress right now. So they're debating about an additional $250 billion of funding to go towards the Payroll Protection Program. However, there's debate between the two parties as to any modifications to the program that the Democrats would like to see. And so until that is hashed out, we're not likely to see that legislation move forward. And as we say here today, unfortunately, the Senate is on adjournment until Monday, so we won't see anything move on this front over the weekend. We have been hearing from a number of our clients that are working with many banks across our footprint that, and I've seen some questions to this extent already coming through on the Q&A. Even though the SBA is not currently accepting any current new applications, they have indicated that once additional funding is put forth, they will open back up and continue to take applications and process them on a first come, first served basis. So us, along with many of the banks that are out there, are still suggesting that people continue to finalize or put in applications to their lending institutions so that they are ready to go as soon as potential more funding becomes available. And, you know, I think I've seen a question that came through just regarding, you know, we were in the process, now that the funding is dried up, how do we continue to move forward, or what should we do? And I think the best answer we can give at the moment is continue to work with your bank, reach out to your banking relationship, and try to complete the application so that you're ready to go if more funding does come available. One of the items that did come out this week in some updated interim final rules from the SBA is in regards to self-employed applicants. So self-employed applicants were not able to apply initially when the program opened up on the 3rd. They had to wait a little bit longer. So the rules around that just came out, I think it was this Monday that they were issued, or potentially last Friday. It really just kind of clarified some of the many questions that were out there about who is self-employed and how do they apply for the program. So here's just a few highlights of how you substantiate your request, what payroll costs can go in. The big things to highlight, I think, here that are a little bit different than what we may have initially thought was partners in a partnership cannot self-file. So even if the partnership only generates self-employment income to its owners, the guidance would say the partnership should be the one applying, not individual partners. From a payroll cost standpoint, you know, the question was, what would self-employed individuals be able to claim as payroll costs for themselves? And it came out in the rules that they can use their Schedule C net profits up to $100,000 plus any employee wages or health insurance, retirement benefits, state unemployment, so on, for the employees that are employed by their Schedule C operation. However, you cannot include those benefits for the owner. You can see on the slide some of the substantiation requirements and then forgiveness considerations. There was a lot of questions if this was included in revenue, you know, would the 100% of the loan be forgivable for a self-employed individual? And they came out and clarified that you really use the, you know, average 8 weeks measurement based on the 2019 Schedule C. The intent was not to give self-employed individuals a better benefit from the forgiveness side. So that was part of those rules as well. So the other big lending program that's out there, it's gotten a little bit of press here lately, probably even more so now that there's been some funding concerns with PPP loan program. The Main Street lending program was part of the CARES Act, just as the PPP program was as well. However, this is for eligible borrowers a little bit larger than what was available under the SBA program. So this is a Department of Treasury program, and essentially it's a loan backing program or purchase program. So just a quick overview, they put $600 billion into this lending program that essentially launched on the 9th, but it actually has not opened up. We've been getting questions from clients where they're seeing links or items on the internet saying, get your application filled out, get in line. We saw that prior to the Paychecks Protection program opening up as well, but as of right now, there are no lending institutions that we're aware of that are starting to process any of these loans, and the Department of Treasury hasn't actually finalized the program, so we're still a lot of guidance to come on this. But the eligibility requirements, employers up to 10,000 employees can be eligible for this. That can also have up to 2.5 billion in annual revenue, so much larger businesses can take advantage of this program. The caveats are they have to be organized in the U.S. or under U.S. law, significant operations here in the U.S., and a majority of the employees based in the U.S. There's two different pieces of this program. There's new loan borrowings and there's expanded loan borrowings. So new loan borrowings, there's a calculation of how much can be lent, the lesser of 25 million, or 4 times the borrower's 2019 EBITDA when adding that to existing and undrawn debt. Under the expanded loan borrowings, this would be an additional extension of current borrowings that you have with the lending institution. This can be the lesser of 150 million, or 30% of the existing undrawn debt, or no more than 3 times the borrower's 2019 EBITDA when added with existing and undrawn debt. The loan terms, this is where it might catch some of the smaller and preclude some smaller businesses from really taking advantage of it. Under the current terms, minimum loan size will be $1 million. So if you do the math based on the two things I said before, under the new loan borrowings, essentially you need to have EBITDA in 2019 of $250,000 to get to a $1 million loan size. Under the expanded loan borrowing, that could drop down to about 166,000 of EBITDA, but that also assumes that you had no prior debt, which you do need for the expanded loan borrowing limit. They're 4-year maturity. They have an adjustable rate based on the secured overnight financing rate plus some upcharge. Amortization of principal and interest can be deferred for 1 year, and prepayment is permitted without penalty. So just wanted to quickly run over that, as it is something that we're getting a lot of questions in our client base currently on. And with that, I'm going to transfer it over to Tony, who's going to cover the many different tax provisions that have come out here recently.
All right, thank you, Eric. Before we get into some of the tax provisions and also some of the opportunities and interplay that there are with the various loan programs, and particularly the PPP loan programs, I want to step back a little bit and summarize the kind of how we got here, what the legislation that has come out over the past month, since I'm going to be referring to that throughout the PowerPoint, and also maybe build on a little bit what Eric said, discuss kind of what we can expect from Congress going forward. So we've had 3 COVID-19 related bills pass in the month of March. The first one, most people probably haven't heard of, but it was really just a bill to actually fight the virus. So it included things like funds for vaccines as well as R&D. Now, the second bill, which Susan's really familiar with, is the Families First Act, and that included the mandatory paid family and sick leave. And then finally, the third bill that came out towards the end of March is the CARES Act, and that included items like the payroll protection loans, and it also included some significant tax provisions that I'm going to cover in just a minute. But just again, to reiterate what Eric said, there's been a lot of talk of they call it, a phase 3.5, and then possibly a phase 4 to the stimulus program. And the phase 3.5 would focus on the continuing funding of the PPP loan program. And like Eric said, the Republicans and Democrats are kind of squaring off on this issue. The Republicans just want a straight PPL funding bill, as Eric said, about $250 billion. And the Democrats want to include some other provisions like state funding, as well as funding for other areas like first responders and stuff like that. But on top of that, they've also discussed a potential of a phase 4 to this, which would include adding some new layers onto this and possibly including the infrastructure spending bill that Congress has been talking about for the past couple of years. So again, as Eric said, they're on recess, or the Senate's on recess until Monday, so we'll just have to wait and see what happens from there. But I really do think, and I'm sure most people will agree, at a minimum, we're going to see an increase in the funding for the PPL program. So let's move on to some of the tax provisions now. The only thing I'm assuming everyone knows at this point that there's been a postponement of any deadline in payments until July 15th. But the only thing I want to point out here is this is a federal postponement. So be aware that not all the states are following the same set of rules that the federal government is set out. So mainly this is due to state budgetary reasons, but not all have postponed until July 15th. A lot of them are still due in June, but also remember your normal extensions are still available. You just may have some state payments due ahead of that July 15th deadline. So the next slide, recovery rebate, again, don't want to spend any time on this, but just know there is a new tool the IRS launched live, I think 2 days ago now, called Get My Payment, where you can actually check on the status of your recovery rebate or economic payment and actually upload some bank account information if for some reason you didn't use direct deposit when you filed your income tax return. So you won't have to actually wait for a physical check to actually come in the mail. Now, there are some individual provisions that I want to focus more on the business side, but since we are talking about funding and cash flow, I do want to point out a couple of the retirement provisions, because you can now withdraw up to $100,000 from a qualified retirement plan without being subject to that 10% early withdrawal penalty. The distribution, there are of course, some rules with the distribution. It has to be related to some type of financial hardship due to COVID-19. Also, you have the option to spread that income inclusion out over a 3-year period, so you don't have to actually pay the tax all in that initial year when you take the funding out. And then you can also recontribute that amount back into your retirement plan over the next 3 years without having to worry about any actual basically without even worry about any actual annual contribution limitations. So that was option 1, being a withdrawal. Option 2, you've always been able to, but you can now take a loan up to $100,000. I think the prior threshold was $50,000. And there's going to be some flexibility and with those repayment terms there. So a couple options on the retirement plan side. Obviously, this is a sort of last resort option, but if it's something you are going to consider, I would definitely reach out to, if you have a financial advisor, to really determine what the best approach for you would be for withdrawing any of those funds. So now moving on to some of the business tax provisions, and I want to focus on how specifically the payroll protection loans interact with some of these new tax provisions, and also how they interact with some old tax provisions as well. But before we do that, I want to cover some of the new provisions so we actually understand what we're comparing items to as far as what is going to be the most optimal program for you to go under. So the first thing on there is the employee retention credit, and this is a refundable payroll tax credit up to 50% of eligible wages paid by an eligible employer. And this is going to apply to any wages after March 12th, and it's going to run through the end of 2020. So there's a couple terms there: eligible employer, eligible wages. So let's talk a little bit about those. So the first test for an eligible employer is that you have to be carrying on a trade or business during the year 2020. And without getting into the issues and the definitions of what a trade or business is, for most companies, it's going to be a fairly straightforward answer to that question. The second thing on there, you need to have operations that were either impacted by a COVID-19 government order or you have to have a greater than 50% reduction in your quarterly sales or your quarterly gross receipts. You're going to measure that by comparing it to the prior year's quarter. Now, impacted by a government order can mean a couple things. It can either mean a full shutdown or a partial shutdown. So for an instance, in the state, Michigan, we have a shelter-in-place order. So if we look at some of those impacted industries, and I'm going to use a restaurant as an example throughout this PowerPoint, but if we look at our restaurants, well, we have some restaurants that have decided to completely close down, and we have some that have decided to continue to do carryout. Either way, you meet the test for being impacted by a government order. So that is an eligible employer. Now, what wages are going to be qualified for this? And first of all, there is a cap, and that's $10,000 per employee. So if the credit is based off of 50% and the cap's $10,000, that means there's going to be basically a max credit of $5,000 per employee. Now, you have different sets of rules based on the amount of employees you have. If you had 100 or fewer employees, the test for eligible wages is going to be very simple. All wages are going to be qualified. But if you have more than 100 employees, only the wages of employees who are either furloughed or face reduced hours but are still compensated for it are going to qualify. So if we look at an example, going back to our restaurant, our position is, if let's say you have a server who obviously is, because no one can come into the restaurant, can't do that, but is also helping out with, let's say, the carry-out side of it. And that server is now working 10 hours for the week versus a 40-hour work week that they would normally work, but they're being compensated for a full 40-hour week. Well, our position is, and it's not clear when you read the statute, but our position is that that 30-hour difference that you're compensating that employee for is going to be qualified under this retention credit. Now, talking about 100 employees, there are a couple tests. So you need to determine employee count by looking at both the Internal Revenue Code and also the Affordable Care Act to determine what your 100 full-time equivalency employees are going to be. So again, if you look at our restaurant example, if I own several locations and I own them through separate LLCs, and in total they're over 100 employees, well, I'm going to have to aggregate all those companies together and to determine my 100 employee count, and I'm going to have to fall under those set of rules for calculating eligible wages under the over than 100 employee test. Now, also not on this slide, but you can also account for the cost of group health insurance plan by basically allocating on a pro rata basis your healthcare expenses across all your employees. So it's not just wages that are included in this calculation. So how do you actually go about claiming the credit? So there's going to be a mechanism on a quarterly 941 payroll tax form that you can use, or as I suspect most people will do, you can claim it in advance by simply reducing the amount of payroll tax and other federal type withholding that you deposit when you actually remit and run your payroll. And there's also going to be Form 7200 that can be filed to claim any excess credit in advance. So if you believe your credit is going to be higher than any tax withholding deposits, you can use this form to request that money back in advance. And I believe the IRS said their intention is to get those funds back within 2 weeks. So again, just a quick example here. Let's say we have 4 employees in our restaurant that are eligible for this credit. So we have, and they can max it out, so they're at 20. So we're basically at $20,000 credit. If let's say we only have $14,000 of either payroll tax or federal withholding for these employees, well, we can then file Form 7200 to request that $6,000 difference between the 20 and the 14. We can file that form to get that money advanced to us. So the next question, and turning this in relating to the payroll protection loans, is how are all these different provisions going to work together? Well, there definitely are restrictions. Number one, we'll talk about this on the next, the slide after the next one. There are restrictions when you receive payroll protection loans. The second thing, wages do not include amounts that you take into account when you calculate certain payroll tax credits. The first one being the Family First Act, which included that mandatory paid sick and paid family leave. So you aren't allowed, and all these restrictions are essentially doing is they're not allowing you to double dip on basically the same wages that you're using across multiple payroll tax credits. So the second item on there, or the third item down there, is the Section 45S credit. This is not the Family First Act credit. It's actually an older payroll tax credit related to paid family and medical leave that's been around for a couple of years. It's generally not going to be as favorable as any of the other credits, so most people aren't actually going to utilize this. And then the fourth one on there is the Workers' Opportunity Tax Credit that is claimed across several specific industries, but you are not going to be able to utilize both the Workers' Opportunity Tax Credit and also the retention credit as well. So one other thing I want to mention is the amount of the credit that you reduce, you have to reduce basically your employee wage deduction by the amount of the credit when you do actually file that tax return. So really the benefit of the credit has to be reduced by your marginal tax rate. And that can obviously vary depending on your situation, but it's not necessarily a straight $5,000 credit per eligible employee, because again, you do lose out on that wage deduction as well. So sticking with payroll taxes, there is a FICA tax deferral for employers. So this allows employers to defer paying the employer portion only of certain payroll taxes, and that's going to be the 6.2% share for Social Security. And you can defer this until the end of 2020. And you repay that amount, because again, it's just a deferral. You're going to repay that amount. 50% is going to come due at the end of 2021. And then the remaining amount is going to be due at the end of 2022. Now, there are some provisions on there for self-employed individuals to defer as well. They can defer 50% of the Social Security tax on their SE income. And they do this essentially by adjusting any quarterly federal estimates that they would normally make. Now, there's a couple things that came out actually recently. So if you do utilize a payroll protection loan and a portion of that loan is forgiven, you cannot defer paying the payroll tax. But this is key, and this just came out on Monday. You cannot defer paying the payroll tax after your lender has actually issued a decision to forgive their loan. So you are eligible up until that time. Again, there was definitely some uncertainty on this, but again, the FAQs that came out earlier in the week did confirm that you still can defer up until that date that the lender actually tells you they are going to forgive that loan. Also, one thing to point out from those FAQs related to this, that deferral of your payroll tax does come before any other credit. So let's say you claim the retention credit. First, you can defer payroll taxes, then you can apply the credits, which means that's a way to kind of maximize the cash flow that will come back to your business. All right, so now let's talk about the payroll protection loans and the tax implications from all these. So if you do obtain a payroll protection loan, as I said, you cannot also utilize that employee retention credit. So what happens if you start claiming that retention credit now, since it applies for wages paid after March 12th, and then because of, well, especially now because the funds for the payroll protection loan have run out, what happens at a later date? You find out that your loan application, or you basically receive a payroll protection loan. Well, the bill authorizes, or the statute authorizes Treasury to create rules for recapturing the credit, meaning basically you'll have to pay it back. So it doesn't appear, at least from what we can see now, that you can claim the credit up until the date of the loan, unlike what I just discussed with the actual payroll deferral. It doesn't appear that you can also do that with the payroll protection credit. And also there really is no guidance on the possibility of when you have to pay back that credit if you're also going to be subject to interest or penalties on that as well. So that's another thing that we're just going to have to wait to see what they do decide on, especially now that the funds have run out and it could be a significant period before they do refund that. We have to wait and see what they're going to do as far as changing the rules on the retention credit. So the second item on there we discussed, you cannot defer, again, until the decision that you can defer up until the decision the bank decides or approves your loan forgiveness. And you're not going to be forced to then pay back those payroll taxes immediately. You're still going to be able to pay those over the pad for the next 2 years as well. So this next item is one of the most brought up questions that we get on the tax side. What about the loan forgiveness piece itself? How is that going to impact the tax side? So just generally when debt is forgiven, you do have to pick that debt forgiveness up in income when you actually file that tax return. Now, there are some exceptions. For instance, if the forgiveness is related to, let's say, your principal residence, you can exclude up to, I think it's $2 million for that provision. But what about the payroll protection loans themselves? Well, it is definitely clear from the statute that any forgiveness related to these loans is not going to be taxable. That we do know for sure. But what we don't know, as we continue to move down the slide, is the IRS going to allow us to then take the deductions for those specific costs that determine the amount that's been forgiven? So, for example, are we going to be able to deduct wage expense that was forgiven, even basically because it was really funded by the government through the forgiveness? Are we going to be able to deduct the portion of the rent that was partially paid for by the government? So, basically it comes down to, do we get the cash flow benefit in the form of the loan proceeds, as well as the tax benefit in the form of the deduction? And as of now, again, no guidance has come out on this issue, but there definitely are instances in the tax code that do disallow deductions when a taxpayer doesn't actually incur an economic cost. Now, I guess my personal thoughts are they will still allow the deduction, because why come out and say it's not to be included in income on one hand, and then on the other hand say, well, but we're going to disallow the deduction? It seems like you're still going to get to the same point if you do disallow the deduction. So another item on there that we are unsure of right now is, what's the impact of the loan forgiveness going to do to for S Corp or a corporation, our stock basis or our partnership basis? Because when you do have cancellation of debt income that is excluded, there are provisions in the tax code, again, that do require you to reduce certain tax attributes, like, for instance, basis. But we just don't know yet what's going to be required. So really, there are a lot of items that, again, we just have to wait on clarification from. And it's definitely specifically related to the tax impacts from the payroll protection loans, but we just need to wait from guidance from Treasury, because anything we do right now would just be a guess, essentially. So
one item, maybe
Sure.
before we move on to that, I see a couple questions kind of talking about how do we account or how do we book the loan advance or the forgivable loan. And I wanted to jump on that while we were on the topic. We've had some discussions internally here with our assurance counterparts on the audit and review side of the world. And I think the conclusion or the thought at the current moment is those would be normal income items for GAAP financial purposes. So they would run through the P&L, and then likely for tax purposes, we'd have, for the forgivable loan amount, a permanent difference for timing between book and tax. And then depending on, to your point, Tony, if there's any change in guidance that would potentially say that we can still deduct expenses for what those proceeds were used for, we either would or would not have another offsetting permanent difference. So before you moved on, I wanted to jump on that one question while it was relevant.
Yep, perfect. Okay, so I want to talk briefly a little bit about some of the other provisions in the CARES Act that don't directly relate to any of the loan items, but also are opportunities for potential cash flow. So the first item on there, net operating losses, you are allowed to carry these back now up to 5 years. So if you did incur any losses, specifically in earlier years like 2018 or 2019, you will be able to actually file carryback returns or amended returns and actually receive a refund for those losses if you had income in those prior years, prior to 2018, and actually receive a cash refund. The other item on there, excess business loss limitation, that's on the individual side. If you were subject to these excess business loss limitations, you can again go ahead and file an amended tax return and basically treat those, and going all the way back to 2018, the year that this provision came into place, basically treat this as if the excess business loss limitation didn't even exist. So that could potentially free up refunds in those prior years as well. The business interest expense limitation modification, don't want to spend too much time on this. It has been increased, so you'll be able to deduct more business interest. The one thing on there that's come out relatively recently, if you are in the real estate field and you did make an election on your return to not be subject to the interest expense limitations, and you did this by basically sacrificing the ability to take any bonus depreciation. So with the new notice that came out, you have the opportunity to go back and basically amend that return and remove that election. So if you are on the real estate side, especially on the commercial real estate side, there's a lot of opportunities there to basically amend some returns to get some more favorable treatment. Now, the one area I do want to spend a couple minutes on, because it was brought up as a topic that has been coming from a lot of SBA members, is the qualified improvement property. So just some background here. When the Tax Cuts and Jobs Act was enacted, there was a mistake made with the wording on one of the provisions that turned qualified improvement property into 39-year property, which made it no longer eligible for bonus depreciation. And this was known as the retail glitch, because it did affect a lot of retails and a lot of restaurants as well. So basically what this meant was, instead of getting an immediate write-off, you have to actually depreciate that asset over 39 years, which would make that deduction a lot less valuable. So this has been fixed, and the effective date is actually January 1st, 2018, which means there is, again, is another opportunity to do some amended returns or file some accounting method changes to actually get some cash refunds. So just a quick example. Well, first, what is qualified improvement property? And it's going to be any internal improvements to a non-residential, so commercial real estate, that aren't structural in nature. So if we go back to our restaurant company again, and we use renovations as an example. So let's say our restaurant group did decide to remodel all their locations a couple of years ago, back in 2018, and they incurred a cost of $1 million. So that $1 million in 2018 had to be capitalized and depreciated over essentially 4 decades. So that's going to only be about a $25,000 deduction per year. But with the new tax change, we can now go back and either amend 2018 and all the owner's returns as well, or file an accounting method change and actually take that $1 million deduction for that tax year, which, if you assume a 30% effective tax rate on that business income, that's slightly under a $300,000 tax refund you're going to receive. Now, again, there are other things that go along with this. We do need to account for the cost of analyzing your fixed assets, determining what spending the time determining what's going to qualify. Also, filing potential amended returns for the business, for the individual shareholders as well. And also, if we do go accounting method change route, the cost of filing an accounting method change. But we definitely think there's a lot of opportunities here. We can see it with our client base, especially on the restaurant retailer side. But this really is applicable to any CapEx heavy company. They can definitely benefit from this as well. So with that, I'm going to turn it over to Susan, who is going to talk about some HR FAQs.
Well, thank you, Tony. Yes, we are talking about this balance between all the finance decisions and now also the people decisions. So one of the things that employers were looking at when the bills start to get signed March 18th is what is their strategies for handling this mix of state orders and federal orders. And so we were looking at all the different options that were really identified before the Paycheck Protection Program. And let's see, we want to move forward. Okay, so moving to the next slide. Oh, there we go. Okay, so our clients that we were speaking with were looking at, well, when do I lay my employees off? Do I do a reduced work hour? What about voluntary leaves of absence? Termination right now is not even an option unless there's a true violation of policy or some individual act by an employee that represents a termination. And then they were also looking at work from home. What we know is that our business owners were looking at, how do I keep my business alive, right? How do I ensure the viability of my business and balance that with not only my long-term employee jobs, but my employees' health? And how do I take care of them? If I lay them off, you know, how are they going to survive? How can I continue to pay them? And so there was a lot of confusion, especially when just the Family First Act came out. And so this is sort of the timeline. Initially, we were only dealing with the Families First Act, which had the emergency paid sick leave, and they had the emergency FMLA. Employers were really trying to use that as a way to keep the employees paid, recognizing they didn't have enough work for them. We soon learned with the Payroll Protection Act coming out, or excuse me, the CARES Act coming out, that there was a much narrower focus of the two leaves. And so paying for our employees while they were off, or while they were off, bring them back and pay them for the leave and then put them back out on layoff was not an option. They had a very narrow definition of what those are to be used for. So then we started to move into these areas of the PPP program. And then layered on that, there was the unemployment program that came out. And now what do we do? Because our employees will be actually eligible potentially for more money than they would be if they continued to work. So a lot of different questions. There was a lot of state changes here in Michigan. We were looking at how do we balance an extended period where they were waiving the option for people to seek other employment. They were broadening the length of time from 20 weeks to 26 weeks. And then the CARES Act with these three different provisions of unemployment sort of expanded it further. So if we look at, you know, what do we do? Now that we have this option to consider around the PPP program, how do I look at, do I lay them off now because I can no longer afford to pay them? And if I get the loan, do I bring them back? And will they come back? How long do I keep them? So there's a multitude of decisions. When we look at the unemployment piece, this is where it created another level of I think, concern or interest on the employer part. Very thankful that the employees that were on layoff now had the opportunity for an additional $600 and a weekly benefit. That for those that had already exhausted for some reason, they're already their 20 or 26 benefit, that it could be extended another 13, which could take them up to a full 39 weeks. And then the last one is that it broadened the benefits to the number of people who currently weren't eligible for benefits, so independent contractors and the self-employed. When we look at the very first one there, the $600 a week in benefits, employees were already laid off and they were wondering, well, when will I start to get that? And so we soon learned that it was going to be effective from April 6th through July 31st. For the the third one there, we knew that the state systems weren't set up for this whole new class of workers. So nor were they set up to identify all the different reasons. So if we look at the next slide here, and especially I'm going to jump to number 4 and 5. Number 4 was that they were going to waive the 1-week waiting period. And so that was great. The state of Michigan, for example, had already waived the looking for work requirements. Number 5 said, from the federal point of view on unemployment, that the state should create these work share programs. Well, once again, Michigan has a pretty good work share program. It's really well defined. And so that gave the employers another option to look at. And with all these different options, how do we best make the balance of providing our employees income and preserving our cash? So we know that the whole concern or broadened reasons around unemployment left us with a broader scope of what the employees would be eligible for. And so again, we have this weekly benefit amount that they could get under the state based on their income and hours worked, but the 600. And now with this broadened list, it started to create concern for our employers. So if I lay my employees off because I'm trying to preserve my cash flow and look for how do I keep my business going, what do I do when a state order is lifted and now we got to bring our employees back to work? This particular slide shows that they broadened it to include more reasons for which employees could apply for unemployment. And I think the couple that threw us into, as a business owner, some concern is new ones. The new ones were more or less number 7, scheduled to start a job, but unable to do so as a result of the COVID-19. Number 8, become a major support for a household because the breadwinner in the household has died as a direct result of COVID-19. Number 9, quit their job as a result of a direct result of COVID-19. And 10, the individual's place of employment is closed as a direct result of COVID-19. The one that sort of created some pause the most was quitting their job. And as with all of these regulations, the initial announcement of the law comes out, and then there's many, many levels of clarification. On the Families First, there was 5 levels of clarification before they sort of settled. On the CARES Act, we saw continued clarification. And in fact, on number 9, there's still a little bit of concern about what happens. How is the state being responsible for identifying if somebody's eligible for unemployment benefit? How would somebody be qualified or disqualified when we aren't even sure how to qualify why an employee says they're quitting? Quitting work without a good cause to obtain unemployment benefits, however, the DOL has stated, is fraud. So part of our whole dilemma right now is how do we help educate our employees around what their responsibilities are when they're looking at these kinds of opportunities, if you would, for unemployment and an increase of $600 per week when they have to self-certify. And that whole process of self-certify has created some concern over what does that mean and how will the state unemployment validate these kinds of things with the individual applying. So they also came out with some clarification that if the individual is eligible to receive at least $1 of benefit as defined by the state, they will in fact get the full $600 for every week that they're eligible. If they are not eligible for the weekly benefit amount of 0, they aren't getting any because they either didn't meet the criteria or they made too much money, then they will not get the 600 federal benefit. And if you remember, the 600 is only available through July 31st. What we're also understanding is every state is interpreting these things a little differently. And so one of my biggest recommendations is that employers pay attention. So for example, the state of Georgia has indicated that all the employers must actually do the application for unemployment for their employees. Connecticut has actually put out guidance on what does it mean if somebody doesn't want to return to work. And they've actually put it in their handbook that says, I received an offer to return to work, but I am concerned about the safety of the position in light of COVID-19. Will I be denied unemployment for that week? So what's interesting is Connecticut has actually said unemployment benefits are paid on a week-to-week basis. If the governor's restrictions are still in place regarding essential and non-essential employment, or if you have concerns regarding your specific place of employment, you may have good cause to refuse your employment as it is not suitable due to possible exposure to COVID-19 virus and would not be denied benefits on that basis. Little confusion here. It's, very creating some debatable issues, and what it's going to do is put the responsibility onto the employer to keep great documentation on when they are bringing and requesting employees to come back to work, what is the reasoning for why they're saying they're not able to come back to work, and actually contesting the claim when we get the Form 1575 from the UIA that says, please clarify why this person is claiming unemployment. One of the big reasons we put people on temporary shutdown is so that we could bring them back, right? And we could define exactly when we wanted to continue their benefits. And I think that's one of the things that our employees don't realize and need to be educated on is what is the impact if they refuse to come back to work. And so things like you are eligible to work, we have telework for you. If you are in fact eligible for a leave under the Family First Act, we need this kind of documentation, we need this kind of attestation from you, and in fact, we're going to let unemployment know if you decline to come back to work for what may not be a valid reason. The decision's still going to remain with the states to make those decisions, and I think you're going to find there's going to be some potential audit going back when employees are self-certifying and it doesn't match the employer's response to when people were able to return to work. We know in the state of Michigan that there's like 1 million people, almost a quarter of the state, that have applied for unemployment. The site crashed the day we had all of our self-employed and independent workers trying to take advantage, rightfully so, of the opportunity to claim the unemployment benefit. And so the state is actively, all states are actively trying to get their systems up to date and manage this in a way that will support them. One of the things that I definitely see that employees need to consider is this communication with employees, helping them to understand what they're doing when they want them to come back to work. What have they put in place from a COVID preparedness plan? How do we manage social distancing? What happens if in fact somebody is identified as COVID-19 positive? What is the employer doing to communicate all these things? What are their policies in place? I think these are going to be the biggest challenges for employers to demonstrate to employees who may have been off now for 3-4 weeks on unemployment, and in 2 weeks when our loans get approved, we want to bring them back. we have to be prepared because we're going to have employees who are fearful because they feel the workplace may not be safe. So we have to communicate what we're doing to relieve those fears. And then we're going to have the savvy employees. We've already experiencing this where they fully understand the laws. They're already claiming that they've had exposure to somebody. So on the Executive Order 2020-36 in the state of Michigan, it's really defining how many days an employee can legitimately be off. Is it 3 days or 7 days or 14 days? And what are the reasons and what documentation do we need to support whether we can pay them under the Families First Act? And then if we do, how do we have the documentation that supports us getting a credit? The last thing is, what's the impact on employees' benefits? When we put them out on temporary layoff, we were putting them out with the insurance, okay, most cases, the insurance providers were saying end of month plus 1 month. So those that were laid off in March, their benefits are going to end April 30th and a COBRA notice will be sent. Those that were laid off in April will have till May 31st. So all of that communication around what does that mean to the employer and the employees around the benefits will also be critical, because I'm not sure our employees fully understand the impact of them choosing not to return, and then what their benefit impact will be, because that could end, and then we all know a COBRA option could be much more costly. Lastly, the DOL has been very clear that if there's an offer of work, it's suitable, whether it's telework or it's on-site work, that an employee refused without a valid reason, it should be disqualifying, and it will result in a duration of suspension for unemployment benefits. So I think we have a huge learning curve, folks, on both the employer side and the employee side. And my biggest communication to employers right now is make sure your plans and policies are in place for when people do return to work, so you can prove that you're keeping the workspace safe, and that you have all the policies in place to really validate what their options are under the leaves, that you in fact will, as under law, have to pay those leaves, and or if they don't qualify for the leave, then what's your personal leave of absence policies? What do we want to have in place to make sure employees feel cared for and that can be brought back to work in an environment that is again, sustainable and valuable for both parties. I believe there's going to be more coming out on this as we're hitting some of these deadlines, but I think it's going to be diligent on our parts to make sure we're keeping the communication lines open with our employees and helping to educate responsibilities on both sides. So I think we're ready for.
Yes, thank you. We have several questions here, and I'll try to get through them quickly. I believe we've answered a few of them. First one is, if an employee refuses to return to work claiming they have COVID, does the employer have the right to move on and fill that position with someone else?
In the state of Michigan, under the Executive Order 2020-36, it currently states you cannot discipline, discharge, or retaliate for somebody who has a COVID-19 related reason. The fact that you need to have communication with that employee to understand what that situation is does not necessarily mean that you can't continue to fill that position with an essential worker if you need that work done. I'm advising all employers to make sure they're dotting their I's and crossing their T's and getting legal guidance. Put an employee on inactive for the moment. Let's make sure we're understanding what the state law represents, as well as our general employment laws in all areas.
Thank you. Another question for you, Susan. What's the effect on employers under the CARES Act in terms of the unemployment benefits? Are employers getting dinged for that?
No, not right now. Your account won't be charged for any COVID-related 19 application. or award. But if it is for a normal unemployment claim, then yeah, that could be a charge to the account.
Finally, another one for you, Susan. If someone is exposed to COVID at work and needs to quarantine, are they eligible for unemployment?
Well, not necessarily, not if they're going to be paid under one of the leaves. So if they're being paid, you're not eligible for unemployment. If you are not working and you're stopped being paid by your employer, then you're not eligible for a leave. So it's a case-by-case basis to really understand what is the circumstance under which the employee status was. Were they on unemployment in a temporary layoff when they got the COVID-19? Have they been recalled to work, or were they actively working and already being paid by the employer?
Okay. Then finally, what's the difference between a furlough and a layoff?
Oh, yeah. So a furlough is usually a reduction in hours, a reduction in pay. I've seen them intermingled. So temporary shutdown, temporary leave, furlough. A true layoff is considered more permanent, if you will. It's like a termination of the employment from the employer. So the language has got a little mixed up. I'd really make sure you take the time to understand what your intent is so that we can communicate that properly. There's very specific reasons for filing under unemployment. And then in fact, the employee selects the wrong reason for filing, then their claim could be totally denied, and it creates a lot of confusion and upset. And so we want to make sure we're communicating clearly what our true plan is with the employee.
Excellent, thank you. This question is for Anthony. How will the IRS process the paper filed amended returns to claim NOL and excess business loss refunds? Are expedited procedures being considered?
Yeah, so the IRS actually came out with a notice last week, not specific to amended returns, but specific to filing the actual carryback forms themselves. So there's a couple ways you can do this. And with this quick refund form, they actually will accept, for the first time, you actually faxing in the forms directly to them versus mailing them in. And for that quick refund, they're supposed to process it in 90 days, although they're understaffed right now, obviously, since a lot of the branches are closed. But specifically for if you do go the amended return route, they haven't announced anything specific on those type of expedited processes. It's strictly for the carryback forms, which most of our clients are going to be utilizing anyways versus an actual amended return.
Great, thank you. And Eric, quite a few questions for you. Is the employee retention credit based on 100 FTEs?
Yeah, and I'll let Tony jump in on this one. I know he's been more into this specific question.
All right.
Yes. So the employee retention credit is, yes, based on, you basically look at the Affordable Care Act to determine that, which uses an FTE test. So it's going to be based on that. And then you look at the Internal Revenue Code to determine how many of your related businesses you have to add up. So there's basically a two-part process for determining that. And there was a few questions I saw come in about the retention credit and the PPP loan. So you can claim them both right now if you haven't received that loan. The question comes, and the way the statute is written, you may have to pay back the retention credits you claim if you do end up receiving that loan, because they do include in there that Treasury can put out guidance on how to recapture the credit, which is basically how do you pay back that amount if you do end up receiving a payroll protection loan. It's not like the payroll tax deferral, which they came out and clearly stated you can use this provision up until the time, and you won't be required to then actually have to pay those payroll taxes back immediately. You can just treat it as if it was effect up until the date the forgiveness was granted.
Excellent, thank you. This next one I think is for you, Eric. On the PPP forgiveness calculation, does an employer who makes a qualified profit sharing plan, money purchase pension plan, or defined benefit plan contribution have to make that contribution during the 8-week period in order to include it in the forgiveness formula? And if yes, is it based only on the eligible compensation during the 8-week period?
Yeah, so there was a number of questions that came in this kind of concept of what are the eligible costs for forgiveness calculated on? Is it payroll incurred during that period, or can it be payments that were pushed into that period? And I'll say, as we sit here today, there's been a lot more guidance on the first part of the PPP loan process, which is calculating your cost base for the amount of the loan that you can take. As we sit here today, there's been not near as much guidance on the forgiveness side. So I can say a lot of these questions about what is it based on, is it stuff incurred, or is it when it's paid? There isn't any specific guidance that I think anybody in our side is aware of at the current moment that would say this is the bright line test. I think our thought process is it's going to be more on a cash basis, right? The intent of the loans are to be used in the 8-week period for payments that meet those thresholds. So as we sit here, my thought would be it's going to be more on a cash basis. What are the actual proceeds traced to and used for during the 8-week process versus, accrual type costs that were incurred during the 8 weeks but weren't paid until later or paid before.
Great, thank you. And thank you for staying on a little bit later here. I appreciate you answering these questions. Eric, can nonprofits utilize the employee retention payroll tax credit, although they can't prove a 50% reduction in gross receipts? If so, are they eligible for all of quarter 2 through 4 of 2020?
Yeah, and Tony, you can chime in as well. But yes, in general, I think not-for-profit employers can claim the credit. There's no restriction on that side.
Correct. They are included in the eligible entities.
Yeah, and I don't currently know if there's any specific guidance if that gross receipts piece could be looked at as contributions or not. But in general, they are still able to qualify for that credit if they are an employer.
This comment's regarding forgiveness shouldn't impact, I just lost it. Shouldn't impact deductibility. Section 265 is on tax exempt interest, not PPP.
No, I think the point of clarification here is Section 265, which is referenced in a lot of the documentation around this, is actually expenses and interest related to tax exempt income. So if the loan proceeds are forgiven but not taxable, they by default are tax exempt income. So 265 would say expenses and interest related to tax exempt, so it's both, would not be deductible under the general rule.
Okay, and back to that employee retention credit, are we to use the number of FTEs when discussing the qualified wages to determine if we are at 100 or more?
Yes, you would look at your full-time equivalency count.
Can I use the PPP loan for my first quarter SUTA and FUTA liability that's due but not yet paid?
Again, I think this gets back to my previous answer of there's not as specific of guidance yet on the forgiveness side, but as my interpretation would be that it's more of a cash basis of things that meet the definition of payroll or forgivable expenses that are paid during the 8-week period. Again, we're still waiting on a lot of guidance on the forgiveness calculation yet. So that will likely come here in the next, few weeks to a month as we get closer to the 8-week period for a lot of these applicants.
Okay, and then the final one, if you laid off employees, how can you get a PPP loan? I thought it was only covered from February 15th to June 30th.
So the loan itself is calculated on a formula based primarily on prior year wages. So even if you currently have laid off employees, you could still apply for a loan amount based on those calculations. The question really gets on the forgiveness side. If you don't restore your employees, if you don't have eligible costs on the back end, what happens to that loan? And likely the answer is if you don't have enough of any of those expenses by not bringing back employees, you just have a loan that's not forgivable under the provisions. Again, we're still waiting on a lot more guidance on the forgiveness side, but you can still apply for a loan, receive a loan based on prior year wages under the calculation. there's just hurdles for the forgiveness side of bringing people back and paying eligible costs during the 8-week period.
Well, thank you so much. I know
Lori-
there's a few more, oh, go ahead, Susan.
Lori, I just want to make one clarification on the furlough. One of the things that is a very good distinction is a furlough or temporary leave does impact the expansion of employee benefits. So I'm not sure I mentioned that. If it's a true termination, then that is a true separation clause and would generate a end of benefits, where a furlough or temporary leave delays that.
And I did want to mention that Susan has agreed to come back with us next week. We will get the information out there to discuss more of these HR questions that are related to this. If we didn't get to your answer today, please send it to sbam@sbam.org, and we will be posting recording of this webinar. And if Raymond allows, we would love to post the slides as well. Thank you so much for being with us today, Eric, Anthony, and Susan. We can't thank you enough. Raymond is a great partner with the Small Business Association of Michigan. We really appreciate it. And again, Sam, thanks for running the slides. So I hope everyone has a wonderful day on this snowy spring day. Hey, it's Friday in Michigan, so take care now. Bye-bye.
Thank you.
Thank you. Thank you.
Bye-bye.